if you're ready to start recording.
Oh, shit.
Great.
Hey, first of all, thank you guys all for participating today. We are going to keep it to an hour or less. This is Scott Hensley with Piedmont Properties in Charlotte, Piedmont Properties, CORFAC International in Charlotte. Please mute yourself. And if you do want to add to the discussion, you can use the raise hand feature, use the chat. And if I'm daydreaming, don't see it, just unmute yourself and shout out. We do want this to be interactive, so we encourage everyone's participation. We got a great panel of investors to participate, but again, this is not necessarily so much an educational
30 minutes to an hour.
Educational session as it is kind of a best practice, sharing what we're seeing out there and what works. So my company's been involved in CORFAC for a little over 20 years now, and I will tell you one of the greatest benefits that we've seen in CORFAC is the members' willingness to share kind of best practices and give other members a look behind the curtain. And I kind of consider this to be just that, kind of a best practices, share what we know, give people ideas, what's working for us, what's not. So today's webinar is probably a little bit different than some of the other ones. It's not really from the perspective of the brokerage side of our business, but really from the investor side. Again, from my involvement in CORFAC, I've come to realize there's a lot of individuals and companies out there who do invest in real estate, whether it be on the individual basis, through partnerships, even through funds. So, and luckily I've got 3 panelists that I've got to agree to join us today. And I did promise them an open tab at the next CORFAC conference. That's the only reason they agreed to participate. But I'm gonna let them introduce themselves. It's Greg Ellis, Mike Lewis, and John Adderholt. And Greg, if we'll just go through that order, if you just want to introduce yourself to people, you know, what market, firm, a little bit about you, that'd be great.
Sure. Greg Ellis, one of the principals at Patterson Woods Commercial Properties, CORFAC International in Wilmington, Delaware. We serve all of Delaware, parts of Northeast Maryland, and Southeastern Pennsylvania. On the investment side, in 2011, 3 partners and I started private equity real estate investment funds. We started our very first fund in 2011. We have had 4 funds and 1 JV partnership outside of that with one of these investors, Blue Vista Capital. At our peak, we had about 1 million square feet of buildings, mostly office buildings, 1 small shopping center. We're down now to 5 office buildings and still have the shopping center, a little less than 500,000 square feet, and happy to share what I know about how we've done.
Great. Mike?
I'm Mike Lewis, Lewis Group in Raleigh, North Carolina. I've been in the business over 30 years, which is hard to believe. I've been in CORFAC 15, and I've brokered, I think, over 1 billion square feet of space and about 7,000 acres. I have owned, leased, developed, and or currently own, lease, or develop office, industrial, retail, and a little bit of multifamily, and I'm doing more multifamily now. So that's sort of my background.
Great. Thanks, Mike. John?
Yes, I'm John Adderholt, relatively new to CORFAC. We are in Pittsburgh and West Virginia, and I'm also the principal of Century Equities. So our brokerage arm is Century Realty, but at Century Equities, which has actually been around since 1984, we have done mostly single tenant net lease, small syndications structured as limited partnerships. The portfolio is mostly retail, but also some industrial and office sprinkled in there. It spans 15 states, but that often just means 1 or 2 properties in states, mostly in the Northeast, Mid-Atlantic, and Southeast. All of our brokerage, we're licensed in West Virginia and Pennsylvania, so brokerage and development things are mostly local and regional. Yeah, I think that's good enough for me.
Great. Thanks, John. So, and then my experience, I've been investing on an individual basis through partnerships probably the last 20 years, mostly industrial. And when trying to put this together, try to get a little bit of perspective from retail, office, industrial. So hopefully we've got that. And again, what we want this to be is interactive, that let's start the conversation, but if anybody has anything to add, please do. Jumping into it, so the CARES Act, I don't know how much anybody's really looked into the CARES Act and what it means for commercial real estate. I think most of the press to this point has been on the PPP and the challenges with the PPP. But in talking to our accountant, there's probably some huge benefits that are in the CARES Act for investors of real estate. And one of the biggest ones is here, what I call the qualified improvement property. And again, as I understand it, this is more just, hey, be aware of this, go talk to your accountant, more so than trying to educate you on it. But as I understand it, that now anything that's a qualified improvement property, which is pretty broad based, it's really anything that is invested in the property that is not enlarging the building, elevators, or structural elements of the building, are now qualified to be depreciated over 15 years. And because it's a 15-year depreciation, it actually allows for the bonus depreciation, which in turn you can elect to do it in year one. I use an example we did last year. We had a small industrial building here in Charlotte that was doing an adaptive reuse for an office tenant. And the deal we structured with them, we basically contributed, I think, $92,000 to the upfit. It was all interior, $92,000. That 100% of that will be deducted or is on our taxes as a deduction in 2019. Unrelated to this, I don't know how many people, when you go through new roofs or whatever, roofs also qualify for a Section 179 deduction. And as part of that project, we actually put a new roof on the building. It's a small building, again, office conversion. I think that was $42,000. And again, that was able to be taken as a deduction in 2019. So you can imagine how much that helped our taxable income by having that deducted. And the other one is just the net operating loss carryback, that if you did have losses in 18, 19, or 20, that you can go back now and file an amendment, or there's 3 or 4 different ways to do it, and really capture those losses that may have been limited in previous years. So I don't know if anybody out there has any other experiences with the CARES Act or what it could do for commercial real estate investors. Jennifer, I'll go to the next slide. Tenants. So we got a kind of an outline just talking about different elements of commercial real estate. And I think the one that we're all dealing with right now more than anything is negotiating with tenants coming back asking for rent holidays. So John, I'll kind of throw it to you maybe, and kind of what have you seen out there, again, in kind of a idea of a best practices, what has been successful?
Sure. And it's still changing, and there's still a lot of unknowns. I think the biggest news the last couple of days, at least on the retail side, was Starbucks. They sent out letters to landlords, initially generic, and now they're specifically negotiating. That was a tough one because they're so big, and they had been paying their rent and not saying anything, which was great. I'm mostly coming at this from a landlord perspective, but in reality, all of us probably, or most of us, are advising both tenants and landlords. So it's kind of an interesting, and just like a good lawyer, sometimes you have to argue both sides. So we're seeing a lot of different things, but I'll just go over what I think is kind of the standard landlord-friendly deal real briefly. Typically, what's out there and what I think you want to encourage your landlords to do is keep the rent reduced period as short as possible. Sometimes just 2 months is going to work, especially if it's a smaller business and they can qualify for PPP, and then get them to pay that back as quickly as possible. And some tenants, national and smaller, are able to do that. So if you give 50% off rent for a couple of months, it doesn't really matter the months, and get it all back in 2020, I think that's a pretty good deal for a landlord. And the tenant-friendly stuff varies so widely. And I was just on the phone with a landlord, a big client of ours, tons of retailers, huge retail park, our biggest client. And they're giving huge breaks to all kinds of apparel tenants, Bed Bath and the mattress companies. They're not doing very well. So they're looking at more rent-free periods for rent forgiveness. But when I'm advising landlords is that for the most part, you do not need to offer rent forgiveness, but there are exceptions, and you quickly figure out who those are. I think the biggest takeaway that I'm dealing with and trying to process is that we don't know the impact yet. Yes, we're opening, and that's good. But with Starbucks coming out, is that going to be the tip of the iceberg, or are we almost through it because we're opening back up? I don't think we know yet. And so that's, anytime we don't know, it's a little bit scary. Oftentimes you need to, as landlords, you're asking your tenant, did you receive PPP? Can you pay rent? And sometimes the answer is yes, but that only gives you 2 months. So it might not lead to anything. The bigger tenants, some of the QSRs, KFC and Taco Bell, a lot of landlords aren't wanting to give them anything. They still have decent sales. So that's a little bit of what I'm seeing. I could go on and on. We have a lot of examples, but that's probably good enough for now. And if you have any specific tenants that you want to shout out maybe later in the call, I can tell you what our experience has been with them.
I will add to that a client of mine owns a Sherwin-Williams, and I'm sure he got the standard letter that was sent out, and he responded. And so if anybody else is dealing with Sherwin-Williams, you reach out to me, and there is not a resolution yet. So, if anybody's dealing with Sherwin-Williams, I'll be glad to compare notes. Hey, I want to throw it to Greg, but before I do so, kind of give Greg a shout out. So earlier on one of our calls, when all this first started going down, talking about, how do you deal with tenants? And Greg suggested that, as a trade-off for some sort of free rent, some immediate rent relief, is to negotiate the tenant to go ahead and exercise maybe a potential option. Now that sounds so intuitive. At the time, I was like, man, that's brilliant, Greg. That's absolutely brilliant. So I've actually used it twice and been successful, and got a couple other ones out there. But again, I'm sure everybody's probably heard about that. But I thought that was just awesome that, the tenants are so focused on what am I going to do for the next 30, 60, 90 days or 6 months, that they'll be willing to trade off and say, yeah, I'll sign, I'll go ahead and exercise my new 5-year option. Now you go from having, maybe a 3-year lease to an 8-year lease. In my opinion, I'll give them a couple months to get that additional term. So Greg, anything you want to follow up on tenants you're dealing with?
Yeah, I'm glad that worked for you, because our tenant backed out of the deal. After they agreed to it, they came back and said, we're sorry, we can't agree to that. So we said, well, we're sorry, you owe us rent. And it's a Planet Fitness. So where we are now with them is, I think we've agreed to give them, they're paying their triple nets. They're not going to pay base rent for 4 months, but then they're going to pay it back over the next 12, or it might even be the next 6 months or something. So it's not entirely in 2020, but it's pretty close. But yeah, that was a great example, a great win we thought we had right from the get-go that went upside down. Our position is, and part of it ultimately with them was, we kept pushing them for financials, and they're like, oh, this is all we can give you. We can't give you anything else. And I said, well, then we're not extending anything. We're not going to be your lender. How can we be your lender if you won't share with us financials? That's totally irrational. Mm-hmm. And so in the end, they're taking the shorter rent holiday deferment and then paying it back fairly quickly, because I think they would rather do that than show us that they're richer than we are, probably. So, because it's a really large Planet Fitness franchisee, and I'm sure they have way more money than we do. So other than that, and most of the problems have been on our retail side. We have 4 tenants that have asked for breaks. A couple of the smaller mom and pops, we've allowed them a few months to not pay and then pay it back over 6 or 12 months. Or one, I think we might be tacking it on at the end, because we just knew that was getting blood from a turnip. On the office side, most all of our tenants are paying. We had one big national, I think I told the story back then, that they sent us a letter saying they wanted a 75% rent reduction. This is a multinational firm. I think the broker was just way out ahead of them on it, because they've paid their rent every month since then, even after they sent us that letter. And we reached out to the broker and they've never responded to us. So, I don't know what was up with that. But we do have a couple of office tenants that aren't paying and aren't really talking to us. I mean, we've asked for financials, we've asked for information, I know one of the tenants is dealing with multiple landlords, and he called me after 30 days. He sent an email. I responded. 30 days later, he says, you know, oh, I need to reach out to you. We're trying to figure out all the stuff. We laid all these people off. You know, I'm reaching out to you because you're our smallest rent payment, and I can, you know, hopefully do my easiest homework first in the morning and then the harder stuff later. And I wasn't his easiest call because I said, you know, we need more financials, and you know, we're not inclined to give you a break. I haven't heard back from him in 19 days. So it'll be interesting to see what happens when he decides to start paying his rent again or reopen his office. You know, we're not trying to be jerks about it, but a lot of these companies, I mean, that company's owned by a private equity firm. I'm sure they have deep pockets behind them. They may be highly levered, but you know, they're in business. If they're going to make it work, then they should pay us. So that's my perspective on the rent. I think collections have been better than we had initially hoped, and hopefully as things start to reopen and people have less excuse to not pay, hopefully we turn the corner on this pretty quickly. So.
I was actually having a conversation with a friend of mine who has a property management company and primarily retail. And he said in the month of April, they collected 56 cents on the dollar. Granted, that's probably more. And I'm thinking that sounds bloody, but if you're in the retail, that may not be all that bad. John, I don't know if y'all track that or not, or if that's kind of consistent. But before I let you go, or before I let you, also on the industrial side, and I think this is, a lot of our industrial clients, yes, they've been affected. And actually, I think they will be more affected in 6 months than they are immediately. And we had a number of them kind of come to us, like you said, Greg. It's almost like, hey, it's an easy ask. You read the newspapers, you listen to the news, all this free rent. Why would somebody not come and ask? And our canned answer is, hey, we're partners in this. Let me see your financials. If you need some assistance, we'll work out something that shuts down half the conversations. Yeah. John, anyway, I don't know if you had any thoughts on what you guys are seeing on.
We're doing pretty well. We're over 80%, but we're heavy in tractor supply, with CVS, some auto parts, no apparel retailers and things like that. So we're doing okay, pretty well. Experience is very similar. It's so funny. You say, well, we're not your lender, but if we are going to be your lender, please share financials. No one seems to want to do that. It's very frustrating. And the deals do change. The thing I was going to go back to was it really depends on the size of the tenant. I think I'm hearing a theme. Mom and pops are getting bigger breaks than the bigger guys. And the bigger companies, I think, are at risk of trying to take advantage of landlords. I hope that we have a lot of Gregs out there that hold the line, ask for financials, but I'm afraid, I don't know. I don't know how that's going to work, especially with Starbucks. We need a all landlord call. Our entire system in this investment real estate is built on the concept of reliable rents from creditworthy tenants. That's a little bit in jeopardy now. That could hurt cap rates long term. It's not great for our industry. So I hope that tenants are willing to share, don't ask for help when they don't need it, and I hope that landlords are professional but hard, like Greg.
Yeah, I'm looking at Dom's comment there, his question, and I think that's the million, billion, $trillion question. You look at so his question is, are rates going to go down anytime soon? If you're deferring rent from now to later, or can tenants afford to repay a higher rent later? It's interesting to me for Starbucks. I mean, that is such a bold thing where they need the premium locations and they're paying premiums for them. Are they so sure that the landlord's not going to say, look, I've got somebody behind you that's been dying for this space. You want to go into default? Go into default. I can't kick you out right now, but once the courts are back up, it's a really bold risk for some of these tenants to be presuming. And Planet Fitness didn't come out and tell us, but we think they didn't exercise. Well, actually, that's not true. They did slip in one of the emails that part of the reason they didn't want to exercise the option was that they think rents are going to go down in the future, and they didn't want to exercise the option built into their lease, even if we were making it better by adding some free rent to it. So I mean, it's the $1 trillion question is where are rents going to be? Are there going to be massive vacancies? You know, should landlords suck it up, you know, in a strip shopping mall or something, because it's better to have less rent than no rent. You know, I don't know where it's going to go. That's the big question.
Hey, before I see what Mike's comments on, I don't know if everybody has a chat box open, but Mason, thanks for weighing in, and that's another great strategy. He just said he's been successful in convincing tenants to remove their early termination options in exchange for some rent relief. Again, great strategy to help the landlord improve their long-term prospects for a little short-term pain. Mike Lewis, anything you want to add? And if not, we can move on.
I think I've seen the same thing, and I've had a couple ask, but I've gone very high credit. In fact, I've even walked from some deals. I'm out of retail now, and I've gone high credit, so I'm not having any trouble.
Yeah. Not to call out Renee or Kurt, and again, this is kind of for the investor landlord's perspective, but if Renee or Kurt, because I know you guys squarely fall on the tenant side of things. I don't know if y'all have got anything to add that what tenants are doing.
You know what? Our mid to large size tenants, they're all paying rent. They're fine with paying rent. We in fact passed on a termination right because we think landlords are hanging tough right now. We've got another termination right in 3 years. Our recommendation is it really depends on the office side what the permanent unemployment rate's going to be. You know, you can't look at the numbers right now. So what we're telling our clients is that right now landlords are getting inundated by a lot of unnecessary requests, as you all have mentioned. We think that it's the time to approach people will be in 2021 because we think, in fact, that's when a lot of larger companies will be hurting, not now. There's just too much liquidity in the market.
Very good. One other quick example, just talking about is probably no different than what you guys are talking about. Again, we had tenant that didn't have a renewal option. We wanted them to, you know, add some term. They came back, wanted free rent. Basically what we ended up doing was just going to them and say, okay, we'll give you anywhere from 1 to 1 to 3 months of free rent only, not expenses, for each additional term you add, for each additional year of term you add. They end up selecting 2. And we felt like it was a win because one, as you guys talked about, is who knows where rental rates are going to be. We feel like that investment is they're probably already paying 15, 20% over market rate. And if it was in normal circumstances, they probably would have had time to go out there, research the market, realize, why am I committing 2 more years at an above market rental rate, where they were just more worried about, hey, 2 months of free rent today, I'll worry about the other later because I got, 80 locations I'm dealing with. So
Right.
Again, I think that was more beneficial again from a landlord than it was a tenant. Jennifer, let's roll to the next.
Actually,
Renee.
I think it intersects. I think that intersects. Trading in a termination right intersects with free rent if you really need it. And what we're advising is if you don't need it, talk next year.
Yeah.
And if your lease is expiring, do a 1-year renewal.
Very good. The next kind of topic was just lender environment. This is all so new that hopefully most of these, still got term left on their note and you're not dealing with this. But I don't know if anybody on the panel has one, and I'll share an example of mine that we just happened to have one that was coming up. So we're kind of in the midst of it. And it was interesting from the underwriter perspective of the questions were so different than normal. It was more them trying to better understand the tenant, not only the tenant, but kind of what business were they in, how effective were they going to be today and going forward. Luckily, it was an industry, a business they got comfortable with. And I will tell you, it's the lowest rate I've ever seen. And this is just a local bank. It was 2.99% fixed for 5 years. And most of our deals are, financed through local lenders. So, for us to see something that, begins with a 2, I've never seen it. Anybody on the panel want any recent experience with lenders?
Is that on your credit card, Scott?
Actually, he told me, because we're not even offering car loans this low anymore. Anybody have any recent experience in trying to renew a loan or trying to find? And we had a conversation, I forgot, maybe it was Mike or somebody had an example of somebody that was kind of pregnant on a deal and was trying to get financing and just was nothing out there. Was that you, Mike, that kind of?
Yeah, they were buying a value-add industrial portfolio in a major southeastern city. They were $2 million pregnant and had to close, and took it out to 35 banks. One out of 35 gave them an offer. They did get it closed, but the equity required went up significantly, as you can imagine. So it's when banks are scared, it's a horrible time to borrow money.
Yeah.
I was just gonna say, I don't deal directly with the lenders on our side, but I know in hearing from the partner who does that, I think we thought we had some deals to defer payments or defer principal payments and pay interest only for a period of time. And now it seems like they've gone backwards on that. So I'm not sure we've even gotten that. So they do seem to be run a little bit scared. I think they're probably saving all that ability to do that for their hotel and hospitality clients and such, rather than for office buildings and shopping centers where we're collecting decent rents.
And Alan Jones made a great comment, and he's absolutely right. The one lender out of 35 was a local bank who would do that deal. So the ones who seem to be more inclined to even talk about it right now are the local banks. And I will tell you, I called out Wells Fargo, a lender, a major commercial guy I know, called him up and I said, I heard you're not lending. And he stuttered and stammered, and I knew him well enough. He finally said, you're right, we're not doing any commercial loans right now, so don't ask.
Alan, Joel, I know you're out there. Any color you want to add to your deal? I don't know if you've got access to audio or not.
Yeah, I do. Hey, everybody. So the 3 deals that we have currently that we actually have loans on, 2 of them are local banks. One of them is under construction or renovation, and they are just continuing to fund as normal. They haven't changed their MO. The second one that is local, which we only had a 45% rent for the April, they've agreed to defer principal and interest for 90 days. So they're tacking it on to the loan, but they're deferring it for 90 days, which is very helpful. So those are 2 local banks. The third one is a CMBS loan. They are non-responsive. In addition, they require that you pay them $15,000 just to reopen and look at any kind of consideration at all. That's just some money you got to pay them to just talk to them. So if you got a CMBS loan, you're in trouble.
Keep paying.
I think that's a great position to take with tenants, is send me $5,000 and we can start a conversation about free rent.
Yeah, really. I can chime in on this as well. A lot of the same experiences. I mean, right when this whole thing started, we have a small new retail development with a small community bank in Western PA is where the development is, Aldi anchored. They reached out and said, hey, if you ever need 3 months forbearance, just let us know. Okay, we'll take it. And then they gave us, without anything, a 6-month extension on an interest only period and said, come back for more when you need it. Wonderful to work with. That was a community bank. Yesterday, I got a call from a regional bank who verbally told me they would refinance a Tractor Supply and then said it died in loan committee. Better take it to a small community bank. And I said, okay, we will. 4 years left on the lease. They didn't want to do it, even though it's a performing Tractor Supply. CMBS is horrible, but a lot of times you have no choice because they have those low interest rates. They are what makes certain deals viable. And so we do have some of those. I've not heard anything from our CMBS lenders. However, interestingly, we have a hospitality affiliate, and I'm not directly involved, but they've been hyper responsive over there with those folks. So CMBS is very difficult, notorious to deal with. They're not even emailing me back. I didn't even get the, if you pay us, we'll talk to you, just nothing back. But some of these community banks are actually calling us and looking for deals. Do you have any clients that are working on anything? And those sorts of interesting calls. But a lot of the bigger banks, I think, have their hands tied.
And that was our experience going into the recession was, we had a couple loans that were performing, loan to value great, everything else. And we had banks that just simply wouldn't even renew it. So, we started having conversations with smaller banks, and we've actually maintained those relationships because they're the only ones. Again, most of our stuff is smaller, talking about $20 million deals. And they were much easier to deal with. And in some instances, you can get in front of the president of the bank. That's not unheard of on some of these smaller lenders. Okay. Jennifer, let's go and go to the next one, which is, what is the next one? Investor perspective. I'd love to hear, again, everybody on the panel, anybody else is just, the bigger picture is just, what do we think that the investor is going to be looking for going forward? Will people look to reallocate more equity into commercial real estate? Will they going to pull it out? Will they expect a higher return, lower return? So I'll just open it up for anybody on the panel if you've got any commentary on what you're seeing, especially for you guys that are dealing with kind of outside investors. Again, our investors are kind of close knit that we have conversations with on a daily basis. So
I don't know what's going to happen. We're not currently raising funds right now. As Mike had said, just on a deal by deal basis, there's going to be a higher equity requirement. So some people are going to have to put more money into the same deals just to make them happen. I'm not getting a lot of calls from people saying, look, I really wanted to get into real estate right now. So I know from our perspective, our fund perspective, we sold almost half of our portfolio at the end of last year, the beginning of this year, which we think was just really fortunate timing. And we're having a real hard time finding opportunities out there that met our criteria. We are not looking for carnage out there in the near future, but we do think there's a possibility that there will be some investors who just don't have the stomach for this, weren't as liquid as they thought they were. And then some banks will push some borrowers out of the business. So we think there will be more opportunity in the future. I don't think it's here yet. It'll probably be 6 to 12 months out. So that's where we're looking right now.
Mike, I know you had some commentary yesterday on your thoughts on.
I would caveat what I would say, Scott, in that Raleigh, being one of the fastest growing places in the country, so much capital wants to come here that we're a little different, as you are in Charlotte. And so we receive constant calls of people trying to put capital in our market. What happened in the downturn, as soon as this happened with COVID, most of the larger developers in the market sent emails to the brokerage community saying, look, we're buyers. We've got cash. We're not trying to steal anything. Just if somebody wants out of a deal, we're here. Followed by, in my conversations with the Cushman, CB, JLL people that I know, they are receiving so many calls every day from people outside the market who view this as an opportunity to come into Raleigh. Once again, not to steal assets or be vulture buyers, but just to get in, that they don't even return all the phone calls anymore. So, we're a little different animal, and I understand that. But as Greg said yesterday, there is so much private equity money that has been raised, historic amounts of capital to go into real estate. And it's got to find a home, or it's got to go back to the people who owned it. And they're looking in our market hard.
Yeah, we had one deal on the broker side in particular that was under contract. It was just a straight investment deal, supposed to close right when it all melted down. And the buyer said, hey, let's hit pause on this. And I think it's not so much that they didn't like the real estate, they still like the real estate. It's almost like, do I want to pay it pre-COVID-19 prices if there's going to be a correction? Pick your number. Why do I spend $1 million a day on a property? Is that thing going to be worth $800,000 in 6 months? So I think, as we all know, the uncertainty kills deals. And I think that's an example. And we kept that alive. Both buyer and seller agreed, hey, let's extend it for 90 days. How much it's going to be different in 30 days from now, I don't know. Maybe we extend it, but hopefully we get it done. But I think it's and the other thing I see is it's kind of like Greg was pointing out, it's almost the opportunity cost of okay, even if I want to allocate some money and buy something today, whatever the valuation may be, do I not have dry powder if there really is a big sale that happens in 6 to 12 months? And now I've spent my liquidity and now I don't have any dry powder to do the really good deal that's 6 to 12 months out.
Well, but also, as we talked about, I mean, there's some structural issues with even trying to make deals happen if you can't find loans. And there's a ton of equity out there. There's a ton of private equity, billions, trillions with Blackstone and all these big funds. But if you can't find the debt for it, there are going to be no deals. So, I mean, we're hoping it's only a 6-month pause, 4-month pause. It's definitely a pause right now. I think we can all agree to that. But how quickly it comes back and where the prices come back is going to be interesting to see, because there's a ton of money. I'm also hearing, and talking to the brokers, and you're probably hearing this too, Mike, all of their sellers who were thinking of selling or teeing stuff up, they don't want to put their properties on the market right now because the perception is that it's going to be a desperate sale. So you have all this money sitting out there and you have no product. I mean, I have it's not completely the same, but 2 kind of funny stories. I was talking to a friend of mine last night who has a townhouse locally. It's vacant. He's not living there anymore. He had rented it. He doesn't want to sell it. He didn't want to sell it because he thought, nobody's looking. It's not the right time. He put it on the market. He had 2 offers on it last night. It was bid from $385 to $415 because there's no product. So there can be just a handful of buyers, and if there's no product, they're bidding it up. I sold my son's bike from 2 years ago for more than I paid for it because you can't buy bikes right now. I sold it on eBay. It's if you can sell, you might try it. I mean, the perception, if it's a good product, there are just enough buyers out there and there's no product to buy right now that we might be surprised that prices actually go up or really hold firm. And maybe 6 months from now, it's just a blip and everyone's like, well, I thought there was going to be a lot of deals, but we're still in the same place. But obviously the huge caveat is that all depends on rent collections. It all depends on NOI. Cap rates may or may not change, but if NOI changes, then values change. So we really don't know what this is going to look like 6 months from now, but I think most people are on hold for right now.
John, any parting comments before we move on?
Yeah, I would say, looking back at the last recession, what we saw was a low yield environment, and that combined with people being grumpy about the stock market led to this cap rate compression. Because we had all these new players enter investment safe commercial real estate because they needed to find income. Everything was low yield. And so the question is, could that happen again? The problem is cap rates never really went all the way back up at all. And now I think people are questioning the stability of commercial real estate, back to what we talked about earlier with even Starbucks coming out with their letters. So I don't know. And then the stock market is not even that bad. So I don't know what it's going to do to cap rates. I think there will be some incidences of stabilized prices, and yes, even maybe some multiple buyers going after things because there's not a lot of product. But it's too early to tell. Some weeks I'm more positive than others. Maybe this week I'm a little less than positive on cap rates.
But the cap rates don't even have to move because the yields have already increased over the 10-year spread. The 10-year spread is huge.
Mm-hmm.
I mean, so
that's true.
Maybe it doesn't even have to change.
That's true.
And it's making
that's true. You get to spread it back. Yeah.
Yeah, the spreads increased.
Mm-hmm.
I mean, the stock market didn't look terrible. The bond holders are certainly pessimistic right now.
Right. Maybe just compete with them.
Well, like we tell our seller clients, you don't need but one buyer. You can only have one buyer at the end of the day. So if you got one buyer, that's good. That's all you need anyway. Mm-hmm. Jennifer, kind of our last slide, and then we'll open up some questions. Again, this is more just in general, whether it's a panelist or anybody else out there, where do you see the opportunities? And this isn't necessarily just on the buying, but even on the brokerage side of things. And I'll start it off, and I told a story. I do think that the sale leasebacks are, I don't know how long the window will be, but I think there'll be a window of opportunity to go out there and pursue some sale leasebacks. We're involved in one right now. It's a industrial trucking related entity. and they have, I think, 17 locations, and we're in conversations with doing a sale leaseback on 2 of those with them. And the idea was, one, some diversification because they own majority of those locations, and also to kind of reallocate that equity that's tied up in those properties with no debt to put it back into the business in the short term. So, and we're not stealing the real estate, but we feel like it's we got pretty good terms on it. So again, I'll turn it over to anybody that has any ideas on where we can find some good opportunities.
I will say that this afternoon, I'm going to actually look at 2 properties I may buy. And it's people that own well-located real estate, high visibility, and they had businesses. Both are retail / showroom industrial type buildings on major corridors. And they've just decided to retire. They're older, they own them free and clear. And they're both talking to me about owner financing. So, they're more concerned about getting a price and an income stream. And I've got tenants for both properties that are national credit tenants. And so, I think there's still opportunities. They'll just look a little different. But I do think there are going to be other people, because I've heard this from quite a few business owners who are older, who just say, I don't have to do this anymore. I'm out. They've been home for a while and they kind of like it.
Where should we send you a check to get in that deal, Mike?
We'll talk later, Scott. It costs you a little more.
I'm sure it will. Greg, any commentary or anything you see where the opportunities may be?
If you read the Biz Now and all the prognosticators, some people think retail is more dead than it was allegedly dead before. Hospitality and stuff like that. Hotels, it's a whole different animal. Can't even predict there. Office, you hear stories of nobody's going back to the office ever again. But I know most people are sick of being at home and they'll be glad to go back to the office. And maybe the companies will have to spread larger. So I think the crystal ball is whatever historical reference or things people talk about. I personally am not sure we have any frame of reference for this. And so I don't know where the specific opportunities will be, but I think people retire. The same opportunities there always are. There are over-levered people who are retiring, people want to change their business. It's the same old thing. I don't think it's going to be a whole lot different. I'm curious as to Phil's comment. Where's that 40 billion per day coming from? From individuals, investors, or the Fed or some Illuminati group or something? Does Phil have audio? Or is he typing his response?
Can you hear me?
Yeah.
My understanding is the government is putting that in there so that although everything else is falling apart, they are not losing their retirement.
I don't think the Fed's buying stocks. I don't think they're allowed to. And I don't know what government agency would be buying stocks, but I don't know. Interesting point. But this is a funny world. Mike mentioned it before. It's a weird world, and there are people who are obviously literally dying. There are people whose businesses are shut down and 30%, they're 20% unemployment or whatever. There are clearly people getting crushed by this, but there's still a ton of money out there. There's so much money floating around the world right now that it's making things really kind of upside down. And where the money's going to settle will drive all of this, at least at the higher echelons. On the mom and pop lower level daily stuff we deal with, it doesn't impact it nearly as much. It doesn't trickle down. But at the big level, it's amazing how much money is floating around out there. And some people are perfectly fine and ready to take advantage of this.
Yeah, and that's the unfortunate thing. I do think it's the folks, whether individuals or business, small businesses that, we're on the cusp of, barely making it, they won't survive. And it's unfortunate. So
I don't know what's going to happen with all these empty restaurants. If restaurants truly, if the math doesn't work anymore, and Joe can opine on this, you're going to have all these empty restaurants that aren't going to be worth converting or anything. So I guess rents go down just to get somebody in there operating the door to make the math work again. I don't know. I don't know what happens with all that excess stuff.
I think there's a lot of confusion right now with the restaurant industry as to how this is going. Right now, first and foremost, they just want to get open and see what the response is going to be. So they're pushing to get open. Even at 30%, they're not going to be making money, which is, what our first phase is, which starts on June 1st. I think it's a wait and see right now. Most of my clients' landlords have done something for them, whether it be deferment, whether, there's a little bit of forgiveness we've gotten here and there in different places. One thing that they're looking for, at least in our market, is the patios. They're looking to expand a lot of patios because there's no restrictions on patios, at least in our reopening plan locally. It's going to be the ever moving ball that we're just going to have to figure out as we progress right now. I mean, there's no rules. There's no, there's no foresight right now. It's going to be adaptability and moving forward. We may have to, look at some rent reductions to make the numbers work. We'll see as we progress out of this reopening plan.
Joe, I've got to ask, are you in the Caymans or something? Just making a deposit?
Unfortunately, no. I'm doing so many of these things that I'm getting creative with my background.
Oh, good. I like that. It's impressive. It fits you.
Oh, no, why not, right? No, that's Lloyd. I got Lloyd's background.
Are you at Lloyd's house?
I'm in his backyard.
We are inside of 10 minutes. I'll pause here and see if there's anybody out there that would like to add to the commentary or ask a question, or they got an issue they're dealing with and would like the knowledge of 49 participants to help them. Anybody?
Has anybody dealt with opportunity zones? I've got something, a property in an opportunity zone that should be very attractive. Has anybody dealt with any of these funds now that the regulations have been clarified?
We've sold a couple of opportunity zones, but quite honestly, before it was almost like that was just an added bonus. In other words, the project probably was going to happen anyway. So I can't, and I haven't dealt with a fund. I do know of a fund that if you're looking for somebody, I can connect you with them that they already own something here in Charlotte. So I can pass along. Yeah, I'll pass that along to you. No.
I have a comment. Scott, this is Chuck in Orlando. One of the things that we've talked about cap rates for investment value, but it really is going to come down to when they start underwriting what kind of collections and vacancy people are going to be putting this number down. This is going to scare a lot of folks. And so, underwriting at 5% vacancy, I think it's gone for some period of time. So that's one of the things I think we just have to understand. It is not focused necessarily on the cap rate, but how the people are going to underwrite it for this vacancy and collections.
Well said, and put it in a different way, exactly, to better, before we start looking at deals, better understand how are the lenders looking at this? What is their new criteria before you go out there trying to chase a deal that's never going to pencil because you can't get a loan. So you just better figure out how they're going to look at it, underwrite something. And I do think they're going to start really underwriting the type of tenant, what the business they're in. That's going to be, that'll probably be the first question they look at. Greg, go ahead.
I was just saying, again, debt drives it all. Without the debt, and the lenders they make the rules. But I think that's what's going to be interesting. And that's where the opportunity may lie, as we've talked about. The lenders run just the entire gamut of the community banks may not change their underwriting all that much. The big banks may. Most of the big banks were at the top end of their allocations for real estate lending anyway. So, it's what's the regional banks going to be, and, the cap rates. I always think cap rates are just such a terrible way to analyze real estate. I mean, we use IRR and cash flows because, we deal with tenants rolling and tenant improvement costs, and, it's not a straight, I spend money and then I collect money, smooth cash flow. But, it's going to be all over the map because everyone's perception of that is different. I mean, that's why real estate being so opaque is beautiful because it creates opportunities with people's different perception levels.
I have a question. How do you think the lenders are going to be? It is the debtor's market, and as defaults happen, how are the lenders going to change?
Well, I think there's one important point that I've heard repeated. The major lenders, the major banks, all have a lot of exposure in the oil and gas industry.
Right.
And so it's going to take a lot of their capital. They had about a third of their $14 trillion liquid going into this. But now with that exposure, who knows? I think that's why the community and regional banks are going to be the players for what we want to do going forward for a while. That's my opinion.
Unless the Fed steps in and gives them a lot more leeway,
Yeah.
and encourages them to have a lot more leeway.
Well,
which
they've reduced the
could happen.
capital requirements, Greg. So they've already done that. They did away with the stuff that came after 08, 09. And so they're saying you don't even have to keep that anymore. So they've tried to do that, but it doesn't mean they're going to lend. And so I think, how do we get them, to let go of some of the money? Because I don't think at this point, the big guys can even quantify their exposure to the oil and gas, and Wells Fargo and JP Morgan in particular, equity lines and that sort of thing. They quit taking all applications in the last 30 days, and they apparently have heavy exposure in those areas too. So it's going to be interesting to see how they get hit by that. It will affect how they lend to us.
Yeah.
Greg, that was an interesting article you shared with me, the results from that survey. I forgot who the source was, but kind of what some of the they were the lender was requiring having 6 months of payments or 12 months of payment or something that, liquid before they would, underwrite the deal or approve the deal.
Scott, I'm seeing the same thing. This is Andrew Boschman. I run the debt and equity team in Philly at Wolf, and I'm out in the debt markets every day, and that's exactly what I'm seeing. I'm seeing leverage. The days of 80%, 75% loan to value are more or less over. And I think the three things that are going to be the most affected for us and on the asset side is going to be your leverage. 60 to 65 is going to be the new normal. Debt coverage ratios, I think 120, 125 is pretty standard. I'm already seeing minimums of 130, 135. And then liquidity, net worth requirements. It's all loans are going to look like agency loans, in my opinion, where you're going to have sponsor liquidity of 10% of the loan amount, and then a net worth of equal to or greater. And that's typically only been Fannie Freddie requirements, but now I'm seeing everyone tighten up on those.
That's good input. Anything else from the debt side, the lender side you want to share with us?
If I knew where it was going to be, I'd be a rich man, but uncertainty is the number one thing. And some of this thing you guys have been saying about local banks, that's absolutely right. And that's something I push when I bring out multiple quotes to borrowers. A lot of times they will take the lowest rate they see on paper from Wells Fargo or the big banks, but try to sell them on the local bank, getting in front of the president, shaking hands with the owners. Now that's really coming into effect. So, now's a great time for local banks to step up and really sell their strength of relationship. So uncertainty right now is the biggest thing I'm seeing. And there are a lot of vulture type double digit bridge, hard money style lenders coming out. A lot of debt funds are poking their heads out. But I think local banks that know the market, that you have a relationship with, are going to be king for the next 6 months.
And again, the product type we deal in, we've always tried to maintain multiple banking relationships because, again, these, especially the small lenders, their buckets get full, and whether they love the deal or not, they just don't have the equity or the debt to supply. So it's great to have multiple relationships that you nurture. And, sometimes we'll even look at renewing a deal with a lender that may not be the best terms, but you know what? I want to stay in relationship, in bed with them. So when I do need them or I do need something else, they're going to take my call and give me a serious look. Okay. Any parting words for wisdom from the panelists? Anything? I think we're a minute away. Is that right, Jennifer? Try to keep it to an hour.
For having this, Scott.
Yeah, thanks.
Great. Thanks, everyone.
Hey, just to let you know, this is all, we'll send out the recording and the slides and all that to everybody, not only on this call, but to all of CORFAC. So thanks, Scott,
Thank you.
Mike, Greg,
Thank you.
and
Thank
it was
you.
great.
Fun, guys.
Hey, this is a good CORFAC value, right? Thanks.
Right.